Prepare for a 35% crash when the Fed pivots. TLT will rise. Rates will fall. 76% of the U.S. Treasury curve is now inverted. Stocks and Treasury bonds usually have an inverse relationship to one another. Ever since 1980s, that's why 60-40 portfolios have been working well to hedge the deflationary recession times, as people can sell their rising bonds to buy falling stocks. This time, that relationship has been 100% erased. Now, if bonds like TLT fall, it will drag the NASDAQ down with it, and the US dollar will go up. All of this is because of inflation. If you haven't figured it out, most recently, I noticed something very interesting. High beta stocks are down, DXY is down, TLT is up. This means Wall Street is preparing for a deflation crash. When will that crash happen? It will happen when the Fed pivots. Most people think, oh, if we beat inflation, stocks will recover back to a new bull market, right? Nah, I will show you why that's not true at all. Why you want to prepare for a Fed pivot crash before the Fed pivots. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do, and push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want it to be real. You want it to be true. You need to be my client, don't you? I'm having once a year a Black Friday event for everyone to sign up for 50% off on any of my packages on my Patreon. So I will be posting the link for you to receive the 50% off. Interest rates probably won't stay high, thanks to a shrinking U.S. workforce and a tech industry in the throes of a midlife crisis, according to Nobel laureate Paul Krugman. The famed economist pointed to the surge in interest rates this year, which has largely been spurred by the Federal Reserve's fight to bring down inflation. Already, the central bank has raised rates by nearly 400 basis points, driving up the cost of borrowing and the yield on 10-year Treasury bonds to touch levels last seen around the 2008 financial crisis. But rates are unlikely to stay this high for long, Krugman argued, suggesting that the era of cheap money, fueled by record low interest rates and abundant liquidity, isn't over yet. For one, higher rates are a lingering effect of the lockdown, when the government flooded the economy with stimulus money. Krugman said households are still spending leftover stimulus, which has supported high prices and therefore higher interest rates this year. But those effects will eventually fade away, and along with slowly investment demand that will likely result in interest rates being dragged lower. An investment slowdown would be a stark contrast from today's market, which has shown exuberance for stocks since the world crisis. But that will be diminished thanks to a slowing workforce In the US, boomers are retiring and younger generations haven't yet replaced them. Krugman said, together, those factors are expected to slow GDP growth and suppress investment demand. Investment spending will only remain high if we expect rapid economic growth. And what we know now doesn't support that expectation, he added. An investment slowdown will also be spurred by what Krugman calls a general disillusionment. In tech, pointing to a recent article from The Atlantic that painted the once high-flying sector as navigating a midlife crisis, while innovation in the 1990s and early 2000s had a bigger economic payoff. Today's investments are ever worse, Krugman said, noting that new projects like Mark Zuckerberg's huge bet on the metaverse could be turning investors away from the space. What all this suggests to me is that the era of cheap money is not, in fact, over. A few years from now, we'll probably be back to a situation in which too much saving is chasing too few investment opportunities, and interest rates will be revisiting their old lows. He added, we already seeing the 3-month yield keep on rising when the rest of the yield curve falls, which means 76% of the U.S. Treasury yield curve are now inverted, meaning recession is in the cards. The Fed will pivot soon. When the Fed pivots, meaning when the Fed starts cutting rates, we will have a crash down, not a melt up in stocks. Now here is what most people get completely wrong about all of this. Because the majority of analysts, economists, and most people out there, they believe when the Fed pivots eventually occurs, whether this year in December or next year in 2023. In other words, when the Fed decides to cut rates, not raise rates, then that's going to be the moment when the stock market will suddenly rally and explode much higher. In other words, the majority of people out there, they believe that the Fed pivot will cause a massive surge in stock prices and a significant rally in the stock market prices. So what their assumption is that they believe that the stock markets will continue to drop and crash further lower until the Fed pivots and start cutting rates. And then the market will rise significantly higher and probably make all-time highs. That's most of people's assumptions. But I want to show you something that explains why the majority people out there are actually wrong on this assumption and view. Have a look at this chart. By the way, this chart you're seeing here is courtesy of Elliott Wave International, Robert Proctor's newsletter. I just think Robert Proctor is a fantastic analyst, and they do a wonderful piece of research in their newsletter. According to this chart by Robert, there is something very interesting about all this. There are two things which this chart shows. Number one, it shows before the Fed pivots, in other words, before they decided to cut rates, the stock market usually rises and rallies right before a Fed pivot. For example, in 2007, the market rallied, and then when the Fed pivoted, when they cut rates, then the stock market began a major decline. In 2000, the market rallied higher. The stock market made a top and start a major decline. Before the Fed pivot, the market usually rallies, and then the market forms a top when the pivot occurs. Then the crash will happen. So by the time the Fed announced they are cutting rates, by that time the stock market is already rallied, made a top, and about to crash down soon. Number 2, the majority of the decline in a bear market occurs after the Fed pivot. This happened in 2007, 2000, 2019, and 1973. In other words, this chart shows if history is a lesson to all of us, this means the majority of the people out there are completely wrong. This makes perfect sense because when the Fed's cutting rates, it sends a signal to the financial market saying the economy is in contractions or deflation. We need to lower rates to jumpstart lending and boosting the economy again. The stock market will then, pricing in the recession or even depression scenario, prices in majority of the stocks. That's when you see oil prices and oil company stocks crashing down. And TLT going to pop. Now I'm going to show you my clients David Vine and Jema's book, Ignite the Passion, Co-Create Your Dreams. It is a collaboration book. Such an awesome book. And my client Teddy Eazzy's book, Wicked Pussy Perfume. It is an erotic novel. Such an awesome book. And my book called Abundance. It is a bestseller. You are such a good boy for watching my video right till the end. Bye.